So friends, now it's time to solve some questions in 115A. So I want all of you to take question number 7 in page number 9. So read that question and give me the answer. Okay, question number 7, which is in page number 9. Go through that question, read the question properly and give me the answer. We'll read that question together and we will solve the answer as well. Question number 7. Jake, a foreign national, furnishes the following data for the previous year ended 31st March 2025. Royalty from Indian concern under an agreement made on 15/9/1996 approved by the central government 3 lakh. So you tell me, we will follow a format, particulars, then analysis, amount. So here what we do is say royalty is the first particular. As you all know, since there is actually an agreement with the central government, but the date of agreement is 1996, hence we can conclude that 44DA not applicable, it will be taxable under 115A. So section 44DA not applicable and taxability will be under section 115A. How much is the amount, friends? It is 3 lakhs. Amount is 3 lakh. And they are talking about some expenses. Can you claim expenses? No. You cannot claim any expenses as a deduction because under section 115A, it is very clear you are not supposed to claim any expenses from section 28 to 44C as a deduction. Not possible. So nothing can be claimed. And hence 3 lakh shall be fully taxable. That is amount we can say. Then interest from an Indian company on money lent in foreign currency. It's a foreign currency interest. Foreign currency loans interest. So interest on loan we can say. So that will be anyways under section 115A and the rate might be 20% because they haven't given any agreement date or other information in the question. So I'm taking it as a general case. Anyways, they are asking us to compute the total income. So whether the rate is 5% or 20% doesn't make any difference, but will be taxable under 115A only. So how much is the income, friends? 11 lakh. So now the question is under that also there are certain expenses. Can you claim those expenses as a deduction? No. Why? Because it is again an item taxable under 115A and you cannot claim any expenses as a deduction while computing income under 115A. Then gross sales of business in India. So that is a gross sale from your business. That is actually a normal income only, not 115A, no special rates for that. It is a normal income only. How much is that income? 28 lakhs. Now there are certain, sorry, not 28 lakh, 30 lakhs. Expenses is 28, okay. 30 lakhs is the income. Now there are certain expenditure from 28 to 44C. Can you claim the expenditure? Yes. It's a normal business income. Definitely you can claim all the expenses as a reduction. So how much is the net income? Effectively only 2 lakh will be taxable. Then what's next? Donation to Prime Minister's National Relief Fund. Before moving on to that, let's compute the gross total income. Gross total income. Gross total income will be 3 plus, it will be 16 lakh. 3 plus 11 plus 2, it will be 16 lakh. Now friends, they are talking about a donation to Prime Minister's National Relief Fund, which is a category 1 deduction. Category 1 deduction under section 80G. What is category 1 under 80G? 100% deductible without any ceiling limit. But there is one problem. How much is the amount? 8 lakh. Before jumping into conclusion, you have to check one thing. Our total income comprises of royalty income 3 lakh, interest income 11 lakh. That interest income is taxable under 115A. From interest income and dividend income, you cannot claim any chapter 6A deduction under 115A. Hope you remember. And hence, only the eligible income where which you can claim chapter 6A deduction is only 3 plus 2. From business income also you can claim chapter 6A reduction. 3 plus 2, that is 5 lakhs. Even though your donation is 8 lakh, eligible income in the gross total income is only 5 lakhs. And hence it is restricted to, this deduction is restricted to 5 lakhs. So the remaining 11 lakh shall be the taxable income, shall be the total income. I hope it is clear. This is how you have to solve the answer. Always you have to check the eligible income. If it is something related to some restriction and all, especially 115A, etc., you need to always check the eligible income. Here the eligible income is only 3 plus 2, that is 5 lakhs, and hence your ATG deduction is also restricted to 5 lakhs. So the rest of the 11 lakh, that means the full interest income, shall be subjected to tax at 20% or 5%, depends upon the agreement, which is not given in the question. So we cannot conclude that. I hope it is clear for you. So friends, moving on with the next topic, we have completed 115A and we have more provisions to finish off in NR taxation. Moving on with the next topic, that is 115AB. It's a simple topic. Section 115AB, and let's learn what exactly is this 115AB is all about. So listen, tax on income from unit purchased in foreign currency or capital gains. Let's understand. It is applicable only to overseas financial organizations. So this provision, eligible assessee should be an overseas financial organization. We can call them as OFO in short. We can call them as what? OFO. What is OFO? Overseas Financial Organization. First of all, let's start with the definition of overseas financial organization. What is overseas financial organization? Means any fund, institution, association, body, whether incorporated or not, but established under a foreign law, which has entered into an agreement for investment in India with any public sector, bank or a public financial institution or any mutual fund. Say you are an overseas financial organization. You can be an institution, fund, association, body, whatever it is, whether registered or unregistered, but you are under any foreign law and you are planning to invest in India either with a public sector bank or in a public financial institution or with a mutual fund. And such arrangement should be approved by SEBI. Our Securities Exchange Board of India should approve that particular arrangement. If you are in that category, then Income Tax Department is calling you as what? OFO, Overseas Financial Organization. Are you with me? So basically it is an entity under foreign law which is planning to come and invest in India either through a public sector bank or through a public financial institution or through a mutual fund. Now for you, what department say, if you have income from units of UTI or mutual fund which is purchased in foreign currency, then rate of tax shall be at 10%. If you are an OFO and you have income from UTI or mutual fund and you have made that investment in foreign currency, then your rate of tax will be only at what rate? 10%. You need to pay only tax at 10%, irrespective of the legal status of you. Even if you are a body corporate, you have to pay only 10% as taxes. Now, if you sell that particular units of mutual fund, and you are having long-term capital gain, and if the transfer is before 23rd July 2024, then rate is 10%. Old rate was 10. But with effect from 23rd July 2024, the rate is 12.5%. Are you with me? So two things. If you are an overseas financial organization having income from UTI or mutual fund which is initially purchased in foreign currency, that investment income is taxed only at 10%. How about long-term capital gain on transfer of that units? If that unit is getting transferred, all the long-term capital gain will be subjected to either 10 or 12.5, depends upon the date of transfer, which is the section 115AB. Are you with me? So that is all about OFO. Now there are certain conditions that you must follow. Number one, can you claim expenses from section 28 to 44C? Income from units not allowable. From long-term capital gain, you can claim direct expenses as well as cost of acquisition. Even though it is not from 28 to 44C and 57, you can claim direct expenses as well as cost of acquisition as a deduction while computing the long-term capital gain. Now, first proviso to section 48, that is conversion reconversion. For investment income from UTA, it's not applicable. For long-term capital gain also not allowable. Why? Because it is applicable only for shares and debentures. Second proviso to section 48, indexation. Not applicable, not allowable. You cannot claim the benefit of indexation irrespective of date of transfer. Even before the amendment, you cannot claim indexation. Chapter 6A reduction, not allowable, not allowable. You cannot claim any chapter 6A reduction from income taxable under 115 AB as well. Not possible. And finally, not number 1. The provisions that is set off carry forward and set off of losses are applicable. You can definitely set off and carry forward of losses over here. That means if you have any losses from the past year, you can adjust that losses with the income taxable under 115 AB. And finally, in the case of listed units, 112A or 111A applies. Listed unit of equity oriented fund if you are purchasing and you are selling. If it is a long term capital asset, 112A. If it is a short term capital asset, 111A. Are you with me? What if this unit there is a short term capital gain? Is it under section 115AB? No. 115AB talks only about long term capital gains. If it is a short term capital gain, then you have to tax it accordingly. Depends upon the legal status of that particular OFO. Are you all here? Are you all here? Is this point clear? There is no point of any confusion. You are an OFO having investment income from UTI or mutual fund units taxed at 10% provided your investment should be in foreign currency. Number 2, if you have long-term capital gain from transfer of that units, depends upon the date of transfer, either 10 or 12.5% bus. There is nothing more in this. Don't expect a question from this section alone. There will be a question where they mix 115A, AB and other things. I'll make you solve such questions. Okay. So for the time being, let's move on. Let's complete the theory and solve the problems. So let's move on, friends. Moving on to the next one, section 115AC. Let's understand what is this 115AC. Let's understand what exactly is this 115AC. That is the rate of tax on income from bonds, GDR, capital gain arising on its transfer. So 3-4 items are covered under 115AC. Listen, say eligible assessee here is any non-resident. Say you are a non-resident, irrespective of your legal status. You can be any non-resident having income, that is interest income, on bonds of an Indian company which is issued in accordance with the central government scheme and purchased in foreign currency. You are a non-resident and you have purchased what? Bonds of Indian company in foreign currency which is issued in accordance with any scheme which is announced by the central government. Are you with me? Or you have interest income on again bonds of a public sector company which is directly sold by the central government and you have purchased it in foreign currency. So both of them are interest. Both of them are bonds also. Number 1, interest from bond of an Indian company which is issued directly by the company but which is in accordance with any scheme announced by the CG and your investment should be in foreign currency. Number 2, you are investing in bonds of a public sector company which is directly sold by the CG. That too investment in foreign currency. If you are getting interest income from these two. And the third one, dividend income on GDR. What is GDR? Global Depository Receipts. If you are a non-resident, you have purchased GDR. You can purchase GDR only in foreign currency. So we don't have to specifically mention that. Are you with me? What is basically GDR? That I know. What is Global Depository Receipts? Say if an Indian company want to list their shares in an overseas RSC, recognized stock exchanges like NASDAQ, Dow Jones, etc. If you want to trade in those, if you want to get your shares traded in those recognized stock exchanges overseas, you have to convert your shares into GDRs. If you want to trade in America, it is ADR. And if those companies want to trade in India, they have to convert it into IDR. We also have IDR, Indian Depository Receipts. Standard Chartered Bank have actually trading IDRs in India. So the concept here is not IDR, it is GDR. So if any non-resident is receiving what? Dividend income from GDR, that also will be taxed under 115 AC, and for all these incomes, single rate, common rate. What is that rate? 10% flat. You have investment in, interest income from bond or interest income from bond of a public sector company, of an Indian company, or dividend income from GDR. All of them taxed at 10%. Now let me ask you one doubt. What if I am selling these bonds? What if I am selling this bonds or GDR? When I am selling this bonds or GDR, the long-term capital gain will be subjected to what rate? Before, if the transfer is before 23rd July 2024, it was earlier taxed at 10%. Now with effect from 23rd July 2024, it is 12.5%. So they have aligned all the long-term capital gains and made it 12.5%. So it's easy to study the rates. Every long-term capital gain is subjected to 12.5%, we can say. Are you with me? So long-term capital gains are subjected to what rate, friends? 12.5%, provided the transfer is on or after 23rd July 2024. Exactly on 23rd July also 12.5. Before 23rd July 10%. Now coming back to the point, friends, there are conditions. Notes. Note number 1. Indexation and reconversion does not apply while computing long-term capital gain. Indexation was not allowed. Reconversion anyway is not applicable. Why? Because it is what? Bonds and GDRs. These are not shares technically or debentures technically. So reconversion as well as indexation benefit you will not get. Then from interest and dividend income, no deduction is allowed under section 28 to 44C or section 57. You cannot claim any deductions from 28 to 44C, as well as you cannot claim any deductions under 57. Nothing can be allowed, both from interest as well as dividends. From long-term capital gain, you can claim direct expenses as well as cost of acquisition as a deduction. From long-term capital gain, there is no restriction. You can claim direct expenses as well as cost of acquisition. How about chapter 6A? Chapter 6A reduction from interest income, dividend income, and from long-term capital gain, not permissible. Or from all the income, no chapter 6A reductions. These are actually similar conditions that we have already discussed under 115A and then AB. Now we are discussing it under AC also. Then, as per section 194C, TDS shall be deducted at time of payment or crediting the pay, whichever is earlier. The TDS rate shall be 10% plus surcharge plus health and education cess. This we will study in the chapter TDS. Just an information. Now, if assessee has only dividend and interest income, you can ignore the note of this TDS, okay? Because we will study this in the chapter TDS. So there is one more benefit over here. If the assessee has only dividend and interest income and has deducted TDS, then no need to file any return. Here, they are giving a benefit to the non-residents. Say the non-resident does not have any other income. You only have this income which is mentioned under 115 AB, AC, plus TDS has been correctly deducted. Then that non-resident is not required to file any return. He have been absolved from filing the return filing requirement as well. I hope this is also clear. Comparatively smaller one, easy one. So it is applicable to non-resident and the incomes are income from interest income from bond, interest income from bonds of a public sector company or an Indian company, then dividend income from GDR and long-term capital gain on transfer of bonds and GDRs. That's all about 115 A, C, and I hope it is clear for you. After completing AD also, we'll solve some questions by mixing everything. Okay. So now let's discuss 115 AD. So friends, what is this 115 AD? Listen, section 115 AD, special provisions for computing tax on income of foreign institutional investors from securities or capital gain arising from their transfer. So basically, this 115 AD is applicable for two persons. Even though in the heading, it is only saying foreign institutional investor, but it is applicable for two types of persons. Number one, FII. FII means foreign institutional investor. Number two, specified funds. So for two persons, 115 AD is applicable. Number one, FII. Tell me what is FII? A foreign institutional investor simply means a foreign bank, or we can say it can be a foreign mutual fund. DII, domestic institutional investment means LIC, banks in India and other institutions that have excess funds. Foreign institutional investor simply means what? A foreign entity or a foreign bank or a foreign mutual fund which is planning to come to India to grow their portfolio. Are you with me? If you are a foreign institutional investor, then 115 AD will be applicable for you. Likewise, if you are a specified fund also, 115 AD is applicable for you. The question is, who is this specified fund? For that, we need to go back to the exemptions. Under exemption, there is an exemption called 10(4)(d). 10(4)(d). This is the exemption. Under that, they are specifying about specified funds. The definition of specified fund is provided under section 10(4)(d). Let's complete this definition and go back to 115 AD. Listen, specified fund simply means it can be a company, LLP, a trust, or any body corporate which is incorporated in India. It is either a company, LLP, trust, body corporate, etc. incorporated in India. Plus, having an alternate investment fund. AIF means alternate investment fund category 3 certificate from the SEBI. That means basically you are an investment company. Depends upon the type of investments, you will be getting category 1 certificate, category 2 certificate, category 3 certificates. Are you with me? So, to call you as a specified fund, you should have a category 3 AIF certification from SEBI. Are you with me? So, basically, you are a company, LLP, trust or any other body corporate incorporated in India having AIF category 3 certificate from SEBI, and you have to be located in IFSC, that is International Financial Service Center, plus all of your unit holders have to be non-residents except sponsors. Are you with me? Just like promoters, except sponsors, similar to promoters, all others have to be NRs. Unit holders have to be NRs, or the shareholders have to be non-residents. Are you with me? 3-4 conditions are there. Specified fund category 1 or point number 1 means you have to be a company having a AIF category 3 certificate located in IFSC. All of your unit holders or shareholders are non-resident except for sponsors or promoters. Are you with me? If you satisfy all these conditions, you will be called as a specified fund. One more specified fund is here. The second one is you have to be an investment division of an offshore banking unit. You have to be an investment division of what? Offshore. What is offshore? Onshore means India. Offshore means outside India. Not necessarily the seashore. Offshore doesn't mean the seashore. Okay, offshore means not in India. So you are a foreign bank. Foreign bank's investment division having a category 1 FPI classification. What is FPI? Foreign portfolio investor. That means you are a foreign bank. You are planning to come and invest in India to grow your portfolio. We can call you as a specified fund provided your investment should be located in IFSC, plus you should commence your operations before 31st March 2025. It has been amended. Earlier it was 2024. Now you got one more year extension. They made it 2025. Are you all here? So listen, two types of persons are normally called as what? Specified funds. Number one, we can say a company or an LLP or a trust or a body corporate incorporated in India having AIF category 3 certification from SEBI located in IFSC. All unit holders are NR except sponsors. Or you are a investment division of a offshore banking unit having category 1 foreign portfolio certification from SEBI, which is located in IFSC and commence its operations before 31st March 2025. If you are in any of these category, then Income Tax Department will call you as specified fund and section 115 AD will be applicable for you. Are you with me? So I hope now you understood who is specified fund. Coming back to the point, friends, listen. We were discussing about 115 AD. And what is 115 AD? It is applicable for foreign institutional investors or specified funds. So now let's discuss 115 AD in a detailed manner. Listen. Say you are a FII. We'll start with FII first. Say you are an FII. What is FII? Foreign institutional investor. Having income from any securities. You are an FII and you are having what? Income from any securities. Whatever income you have, that entire income shall be taxed at 20% rate of tax under 115 AD. Are you with me? Very simple. If you are a FII having income from securities, security means shares, debentures, whatever it is. Whatever income you have from security shall be taxable at 20% rate of tax. And for specified fund, the rate of tax is only 10%. If you are a specified fund, income from securities will be taxable only at 10% rate of tax. Are you with me? Is that point clear? Moving on. There are certain exceptions to this point. What are the exceptions? Listen. See, can you go back to 115 AB? Go back to 115 AB. What is 115 AB? It is applicable for overseas financial organization. Are you with me? What is overseas financial organization? Do you remember the definition? It can be any fund, institution, association or a body. It can be incorporated or unincorporated under any foreign law which enters into an arrangement for investment in India with any public sector bank or a public financial institution or a mutual fund. So we can call investment division of an offshore banking unit as OFO also. Are you with me? You can call an investment division of an offshore banking unit as OFO because it is offshore. It is as per any foreign banking law. And it is incorporated. Whether it is incorporated or unincorporated, OFO does not say any difference. So this offshore banking unit can also be called as specified fund. If it is an IFSC having FPI, Foreign Portfolio Investor Category 1 certification, and if they commence their activities before 31st March 2025, we can call them as what? Specified funds as well. Are you with me? So there is an overlapping in the definition. Are you with me? Due to the overlapping, let me ask you one doubt. Units of mutual fund can also be called as securities. Yes or no? Say you have income from units of a mutual fund where you have made an investment in foreign currency. It will come under 115 AD as well as 115 AB. Because 115 AD says any income from securities of specified fund. 115 AB says income from UTI or mutual fund for an OFO. So you tell me, if that comes under both AB and AD, which one will prevail? AB will prevail. AB. Why? Because it is specific. You have investment income from UTI or mutual fund. It has to be taxed under 115 AB, not AD, even if the definition overlaps. Don't worry, you have to tax it under 115 AB. Are you with me? Coming back to the point under AD, that's why I've given it as an exception. Income from mutual fund or UTI under section 115 AB will be taxed at 10% for an OFO. The second one you can cross off. That is basically not applicable. Second one you can cross off. That is basically not applicable right now. After the amendment, second exception is not applicable right now. You can cross it off. So point is pretty simple. If you are an FII, then all the income from securities will be subjected to 10% rate of tax. If you are specified fund, all the income from securities will be taxed at 10%. For FII, 20%, and for specified fund, 10%. Now, you have short-term capital gain on transfer of such security. If you are an FII or a specified fund, rate shall be same, it shall be 30%. Are you with me? If you have short-term capital gain on transfer of security, whether you are FII or specified fund, doesn't make any difference, rate shall be at 30%. And for that, we can say an exception. If that security is a listed security, it will come under 111A at what rate? Depends upon the date of transfer, there is 15 or 20. If the date of transfer is before 23rd July 2024, then it is 15%. If it is after 23rd July 2024, on or after, it is 20%. I haven't written the date again. You know it because we have already discussed it under basics. Now we will have a detailed discussion again on under capital gains. So if it is a listed unit of equity oriented fund or a listed share or a listed unit of business trust, those are securities. Having short-term capital gain, don't worry, you pay the taxes under 111A. Depends upon the date of transfer, that is before 23rd July 24, rate was 15. Now it has been amended and made it 20. Are you all here? Moving on to the next one. If you have long-term capital gain on transfer of such security, you are an FII or a specified fund, rate of tax shall be at 10%. If you have what? Long-term capital gain on transfer of FII or a specified fund, then the rate of tax shall be say 10%, subject to one exception. What is that? Exception means long-term capital gain under section 112A shall be taxed at 10% or 12.5% for an income exceeding 1,25,000. That means, say you have listed securities, listed share, and you are transferring it. Long-term capital gain have to be taxed under 112A. And what is the rate? 12.5% latest rate. Old rate 10%. Over and above 1,25,000 rupees. I hope it is clear. If you have any other income, in 99.99% they will not be having any other income. But still, if they have any other income, then tax that normal rates. Say some other interest income or something, then it is taxed at what rate? Normal rates. Depends upon the type of FII or specified fund. The legal structure of FII and specified fund depends upon that. You pay taxes at the normal rates. Are you all here? Are you all listening? Good. Now, there is a certain conditions that you are supposed to satisfy under 115 AD, and let's learn the conditions one by one. Listen. Expenses from section 28 to 44 C, as well as deductions under section 57. Income from units not allowable. While computing long-term or short-term capital gain, you can claim direct expenses as well as cost of acquisition is allowed. While computing income from securities, you are not supposed to claim any expenses as a deduction. First proviso to section 48, conversion, reconversion. From investment income, not applicable. From long-term and short-term, not allowable. Second proviso to section 48, indexation. From interest income, not applicable. From other income, long-term and short-term, not allowable. Chapter 6A, not allowable, not allowable. Easy. Same as that we have discussed under 115 AB, AZ, 115A, etc. Are you with me? Now, note number 1. In case where assessee being individual or AOP, then other than AOP consisting only company assets members or BOI or AJP having income under 115 AD, then enhanced surcharge rate of 25% and 37% is not applicable for dividend income and capital gain referred under 115 AD. If you are in the category of individual, anyways FII cannot be HUF. Okay, so individual, AOP, BOI, AJP. Hope you remember our surcharge slab. What was the surcharge slab? Up to 50 nil, 50 to 1 CR. It was 10, 1 CR above, it was 15, 2 CR above, 25, 5 CR above, 37. In that, 37 and 25 is not applicable for those incomes which are taxed under 115 AD as well as for the dividend incomes. Not applicable. Which rate? 25 and 37. The rest is applicable. In the case of default tax rate, AOP and BOI and individual can opt for 115, BAC also. If they are opting for BAC, then maximum surcharge rate is 25% instead of 37%. There also, you don't need to pay taxes at 25% for the income taxable under 115 AD. Not number 3, in the case of AOP consisting only company as its members, hope you remember. For them, for all incomes, 25 and 37 is not applicable. Hope you remember. We have learned something similar to this in basic concepts. Are you all with me? So here the speciality is for incomes taxable under 115 AD and dividend income, 25 and 37 not applicable. That's it. So these are the things that you should study in 115 AD. It is applicable for 2 types of persons. Number 1, specified fund, and number 2, FIIs. Now let's solve some questions based on this. So please take your question number 9. Question number 9. It's a fantastic question. Okay. Please take question number 9. So friends, this is basically question number 9 in page number 10, Neptune Incorporate. So go through that question, read it carefully and give me the answer. So what are they saying? Question number 9, Neptune Incorporate, a notified foreign institutional investor, derived the following income from the financial year 24-25. Interest received on investment in rupee denominated bond of ABC Limited, an Indian company. And the amount of interest is how much, friends? 8,50,000. So what we can do is we'll follow a format. In this question, they are asking us to compute the tax liability as well. Okay. So we'll stick on to a format where it is, say, particulars, then amount, then basic tax liability, so that at the end of the question we'll have a answer altogether. Okay. So starting with the first item, what is the first item? That is interest received on investment in rupee denominated bond. So interest from rupee denominated bond. You tell me bond is basically security and you're having interest income from security and you are an FII. So it will be taxable under which section? Under 115 AD. First of all, write the amount, that is 8,50,000. Is there any expenses? Nothing they are mentioning. So basic tax liability will be under section 115 AD. And what is the rate? 20%. Being FII, the rate of tax will be at 20%, and we will compute that basic tax liability after computing everything. Okay. Now, second one. What is the second item? Interest on security. They are directly given interest on security. Up to financial year 23-24, that interest from rupee denominated bond had another rate. After amendment, that is not actually applicable. So interest on normal security, again 17,32,000. And there are certain expenses. You tell me, can you claim the expenses as a deduction? No. From income taxable under 115 AD, while computing the interest income and other dividend income, etc., you cannot claim any expenses as a deduction. So again, taxable under section 115 AD, and what is the rate? 20%. Then what is next? Dividend from listed shares of an Indian company. So we can say dividend income. Dividend income of listed shares of an Indian company. The amount is 6,20,000. Again, we can say 115 AD, and what is the rate? 20% rate of tax. Are you with me? So 115 AD, rate of tax at 20% again. Next is income from sale of security. So it is something related to sale. So bonds of Jupiter. It is bonds of Jupiter. What is the full value consideration? Before that, date of purchase is on 2021 and date of sale is 2024. So the period of holding, if you check from 21 to 24, 22, 23, 24. Anyways, it is long-term capital asset because the period of holding criteria right now is how many years? It is 24 months. It is more than 24 months, and hence we can say it is basically a long-term capital asset. So, okay, that is actually a correction. Okay, make it 2025. Make it 2025. Then I think period of holding is how many years? 22, 23, 24, 25. Make it 2025, obviously. Otherwise, there is no, it doesn't make any sense. Okay, 2025. That is only a typo error. Make it 2025. Now, you tell me it is going to be a long-term capital gain. And for that, let's take full value consideration first. Full value consideration is how much, friends? It is 47 lakhs, right? Then, how about the cost of acquisition? There is no direct expenses. It is 32 lakhs. Cost of acquisition, direct expenses, you can directly claim. Then, how much will be the long-term capital gain? Can you tell me the figure? 15 lakhs. And you tell me under which section it will be taxable? 115 A, D, because it is a bond. Bond is basically a security, and tell me how much is the rate of tax for that? At 10%. Why 10%? See, listen. For long-term capital gain, it is at 10%. That's what the Act says. So the rate is at 10% irrespective of the date of transfer over there. So tell me, friends, the rate is at 10%. Now, moving on to the next item. What is the next item? Listed share of earth. Next item is listed share of earth. Listed share of earth private, not private limited, earth limited. That simply means it is if it is long, under 112A, if it is short, under 111A. Let's check whether it is long or short. It is short only, because they have purchased it in the year 2024 and they sold it in the year 2025. That is within that year itself, within that financial year itself, they have actually sold it. And now you tell me full value consideration is 12,40,000. So we will write the full value consideration first. 12,40,000. And how much is the cost of acquisition? Cost of acquisition in that particular case is 7,80,000. So you tell me how much will be the short term capital gain. It is 4,60,000 is the short term capital gain, which will be taxable under 111A at what rate? Depends upon the date of transfer. It is on 9th of February 2025, and it will be 20%. If it is before 23rd July, it would have been 15, but after 23rd July, it is 20%. Then, what's next? Next is unlisted equity share of Mars. So we will write unlisted equity share of Mars Limited, and the date of purchase is 24 and date of sale is 25. Again, short term. So we can say full value consideration is 8,40,000. How about the cost of acquisition? That is 3,72,000. And can you tell me how much is the short term capital gain? 4,68,000. Again, it is a short term capital gain under section 115A, D. And you tell me what is the rate of tax? The highest rate, that is the 30%. FII, if they are having short term capital gain, it is subjected to 30% rate of tax. I think that's it. Now we can compute the total income first. So first of all, help me in computing the total income. How much will be the total income? Can you add these items and tell me how much will be the total income? 56,30,000, right? Now, the advantage of this format is now you can quickly compute the basic tax liability. How much is 8,50,000 at 20%? Can you help me? 8,50,000 at 20%, 1,70,000. Okay, 1,70,000. Second one, how much is 20% on 1,732? 3,46,400. How much is 20% on 6,20,000? 1,24,000. How much is 10% on 15 lakh? 1,50,000. Then, how much is 20% on 4,60,000? 92,000. How much is 30% on 4,68,000? 1,40,400. Now, can you tell me how much is the total basic tax liability? Total basic tax liability is how much? 10,22,800 shall be the total basic tax liability. Now tell me friends whether surcharge is applicable. Answer is no. Why? Because it's a company. Neptune Incorporate means it's a company. For a company, the surcharge slab starts from 1 CR above. It's not AOP, BOI, AJP, etc. If it was AOP, BOI, AJP, etc., there would have been a surcharge liability. But since it is a company, Neptune Incorporate means a foreign company, you don't have to compute any surcharge over here because it is only 56 lakhs. So, cess will be there anyways. Cess will be at 4%, 40,912. Adding that to, how much will be the total tax liability? 10,63,712 will be the total tax liability. I hope it is clear. So this is how you have to compute the answer, and I hope it is clear for everyone. Now friends, we will complete the rest of the theories as well. We have some more theories in this chapter to complete. Thereafter, we'll solve the other problems as well. Next is this is the most easiest flat rate in this chapter. If they ask this in exam, then you should say thank you to the person who set up the question, because this is that easy. Okay, so let's understand what is the last flat rate. Special provision for computing tax on non-resident sportsmen or sports association, etc. Listen, imagine you are a sports person who's not a citizen, not a resident, non-resident, non-citizen, sports person, having income by way of participation in India in any game or sport, or having income from advertisement, or having income from contribution of articles relating to game or sport in India in newspapers or magazines or journals. For all these three income, the sportsmen have to pay a tax at 20% rate. Simple example, Glenn Maxwell. He is basically an Australian cricket player who is non-citizen, non-resident in India. He will come to India every year to play what? IPL. Alright, he will come to India. I don't know whether he is playing in the latest IPL series. I don't know whether he is actually playing or not. It is an example. Okay, don't tell me that sir he is not playing in the latest IPL. Okay, say every year he comes to India and play IPL for different teams. I think earlier he was playing with RCB. Yeah, so he will play for RCB, and you tell me RCB will have to pay him a lump sum amount for participating in IPL. And from the perspective of Glenn Maxwell, if you think, Glenn Maxwell is providing his activity in India. So whatever profit or whatever income that he earns from that IPL shall be taxable in India in accordance with section 115 BAA at what rate? At 20% rate of tax. Plus, say Glenn Maxwell is acting in an advertisement when he was in India. The brand will definitely give him a lump sum amount for acting in that advertisement. That income is also will be taxable in India in the hands of Glenn Maxwell. For that income also, he is supposed to pay tax at 20%. Plus, say Glenn Maxwell has given an article, have written as article related to sports. What should be the diet? What all are the exercises? Something like that. Say it is a paid article. There will be a kind of a thing called paid article. Paid article means that magazine will pay something to Maxwell. He will share some inputs and he's getting an income. And the income, if it is taxable in India, that is also subjected to what rate? 20% flat rate. So Glenn Maxwell, three incomes. Number one, for participation in any game or sport. Number two, advertisement. Number three, articles which is related to sports in any magazine, newspaper, etc. Now let me ask you one simple question. Say Glenn Maxwell participated in Big Boss. Okay, he participated in Big Boss. Alright. Now you tell me he won the first prize. He won the first prize. Is that can be considered as a game? No. game which is related to sports, that cannot be called, even though it is a game, it's a TV reality show, and that income will be casual income. Or say Glenn Maxwell visited Goa and played some card games over there, and he won some card games from casinos. Can you call it as a game? No. Even though it can be generally said as a game, it is not game as per the context. So those incomes are taxable under 115 BB at 30% being casual income. That's why in brackets I have written other than referred under section 115 BB. For casual incomes, you cannot call that as a game. For card games, even though we call it as a game, that is not as per this context. So those games, our taxability will be under 115 BB. Casual incomes are taxable under 115 BB, and the rate of tax will be 30%. So that is item number 1. I hope it is clear for you. Are you all here? Superb. Second one. Say you are being a non-resident sports association or institution. What do you mean by non-resident sports association or institution? We'll take the example of Cricket Australia. Cricket Australia says coming to India for playing a one-day international, ODI. Cricket Australia is basically a non-resident sports association. When they come to India, the BCCI have to share a revenue with them also. Whatever the ticket cost, satellite rights, then advertisement expenses, advertisement incomes, etc. A percentage of that revenue have to be shared with the Cricket Australia as well. And now you can say that Cricket Australia is earning some income from India. If they are earning some income from India, they have to pay taxes at what rate? 20% rate of tax. Are you with me? If you are a sports association also and you are having some AD income, you are being a non-resident sports association, for all your incomes you have to pay taxes at 20%. Are you all here? Institutions like Cricket Australia cannot earn any other income. Maybe they will be having some interest income. Apart from that, anyways not from India, because their bank account will be in Australia only. So they will not be having any other income which is related to cricket playing only. That will be taxed at 20% rate of tax. Are you all here? So if you are a non-resident sports association or an institution, then you tell me what will happen. Whatever income that you earn will be subjected to what rate? 20% rate of tax. Moving on with the next one. You are being an entertainer who is not a citizen of India as well as a non-resident. What do you mean by entertainer? Say Justin Bieber. He came to India for performing in Anand Ambani's wedding. So he have done a performance in India. Are you with me? For that, Justin Bieber have to be paid a lump sum amount. And that amount that Justin Bieber is earning is actually taxable in India because he have provided his performance in India. And hence that for that entire income, Bieber have to pay tax at 115 BBA at what rate? 20% rate of tax. Are you with me? So, being an entertainer who's not a citizen of India and a non-resident includes any income from his performance in India will be subjected to 20% rate of tax. Now listen, if it is a casual income which is mentioned under 115 BB, then what is the rate of tax? Income tax calculated at income by way of winnings from lottery, crossword puzzles, races, horse races, etc., card games, etc. will be taxed at 30% flat. Now, when you compute income under section 115 BBA, you are not supposed to claim any deduction for any expenditure. That is point number 1. So friends, listen, so when you compute income, which we have mentioned under 115 BBA, you are not supposed to claim any expenditure as a deduction. It's actually a flat rate taxation. Whatever income you have is subjected to what rate? 20% rate of tax. That's what it is called as flat. You are not supposed to claim any expenditures as deduction. Now, assessee, if he does not have any other income, say Glenn Maxwell, while coming and playing IPL in India, it is not practical to tell him to file return on the due date. So what department say, whenever Glenn Maxwell or other association or entertainer earns some income in India, if TDS has been correctly deducted and that person does not have any other income, then he is absolved from filing the return. You are not supposed to file your returns, provided two conditions are there. He should not have any other income, plus TDS has been correctly deducted. When Justin Bieber comes in, we all know that Justin Bieber does not have any other income in India. And when Anand Ambani or Ambani, whoever it is, when they makes the payment to Justin Bieber, they will deduct the TDS under 194E. At what rate? 20% plus surcharge if any plus cess. It's always 20% plus cess. Because if pay is NR, then TDS rates are always subjected to cess as well. Plus surcharge if any. So you have to deduct everything and make the payment to the weaver, and weaver thereafter is not required to file his return. If he wants, he can file. It is not mandatory. Weaver say, I want to file a return in India, then he can do that. It's not mandatory. Are you all with me? So this is what 115 BBA is all about. I hope that also was clear for you. So friends, now we'll solve some questions in relation to 115 BBA. So I want all of you to read question number 10. Go through question number 10, read question 10 and give me the answer. So friends, let's solve that question and let's read the question and solve it together. Smith, a foreign cricketer, a foreign national and a cricketer came to India as a member of Australian cricket team in the year ended 31st March 2025. So he received 5 lakhs from participation in matches in India. So match fee, we can call it as match fee. And you tell me how much is the match fee that he received? 5 lakh. Then, what is next? He also received 1 lakh from advertisement of product on TV. So advertisement on TV is another 1 lakh. So as you all know, both are taxable under 115 BAA. And what is the rate? 20% under section 115. Come again? BBA, not BAA, BBA. The rate of tax is at again 20%. Now, what is next? Now they are saying he contributed articles in newspaper for which he received 10,000. So newspaper articles, that is also subjected to 150 BBA. Newspaper articles. How much is the amount? He received another 10,000 for that. Again under section 115 BBA and the rate shall be 20%. Then he have one more income, that is 20,000 from horse racing. Horse racing, how much is the income? 30,000. That will be 115 BB. Since casual income, it is taxable at 30%. Can you tell me how much is his total income? 6,40,000 is his total income. And how much is his basic tax liability? The first three at 20%. That means 6,10,000 at 20%. How much is 6,10,000 into 20%? These three, 1,24,000. 22. Okay, 1,22,000. And the third one, 30% on 30,000. That will be 6,000. 30% on 30 will be, that horse racing is not 30, it is 20 only. This is not 640, this is 630 only. Okay. Yeah. So horse racing, it is 20,000 and it is subjected to 30% rate of tax. That's why it is 6,000. Can you tell me how much is the total basic tax liability? 1,28,000 is the total basic tax liability. Now there will be cess at 4%, and how much is 4% on 5,120 will be 4% on 1,28,000. Can you tell me how much is the total tax liability? 1,33,120 is the total tax liability. Done. Compute the tax liability of Smith for assessment year 25-26 that we have already computed, 1,33,120. Are the incomes specified above subjected to deduction of tax at source? Obviously, yes. What is the rate of TDS? For these three income, it is subjected to 194E at 20% plus 4% effective rate cess. So effectively it will be 20.8% on 6,10,000. And the last one, this 20,000 is subjected to 194 BB. being horse race subjected to 30% plus 4% cess. Effectively, it will be 31.20%. Why 31? On 30%, you have to apply 4%. So 30 is 4% is 1.2. So 30 plus 1.2 will be 31.2%. So this is the TDS under 194 BB. Now what is next? Is he liable to file his return of income for assessment year 25-26? Yes, return of income is mandatory. Why mandatory? Because he have income from horse races. He should not have any other income plus TDS if has been correctly deducted. He is not supposed to file returns. But in this case, he has income from horse race and hence he is supposed to file a return. What would have been his tax liability had he been a match referee instead of cricketer? If he was a match referee instead of cricketer, then you tell me what will happen. Very simple. If he is a match referee, then his income shall be taxable at what rate? These three incomes shall be treated as professional income because 115 BBA not applicable to match referees, coaches, etc. They are professionals. Are you with me? These provisions are applicable only for sportsmen who is actually playing on the field. So for umpires, coaches, match referees, this is not applicable. So if he is a match referee, then what we can say is three incomes. Number one, match fee. That is 5 lakh. Then second one is advertisement. That is 1 lakh. The third one is newspaper contribution. Newspaper article contribution. Okay, newspaper article contribution 10,000. These three will fall to slab rates because there is no specific flat rates in Income Tax Act. So these three will fall to the slab rate and horse racing will be subjected to the same 115 BB at 30%. So can you tell me if you put 6,10,000 in slab up to 2,50,000 nil, 2,50,000 to 5%, 5 to 10, 5 to 10, 5 to 6.1, it is 20%. So tell me how much will be the tax liability if you put this on slab rates. 6,10,000 if you put on slab rate, it is up to 2.50 nil, 2.50 to 5 lakh. 5% that will be 12,500. Then the rest is 1,10,000 is subjected to 20%. That is 22,000. So altogether it will be 34,500, right? It will be 34,500. Now you have 30% on 20,000, that is 6,000. And all together 34,500 plus 6,000, it will be 40,500 and cess at 4% on this figure. And how much will be 4% on 4,500? 1,620. And can you tell me how much? 42, 120 will be the effective rate of tax if he is a match referee instead of cricketer. That's it. Now moving on with the next provision. Next provision is again totally unnecessary for us, but still I'll tell you what exactly is the overall provision. Okay, next things are actually not required, but still 115 JH, conversion of an Indian branch of a foreign company into subsidiary company. Say for example, imagine a case where there is a foreign bank's branch in India. A foreign bank's branch was there in India. In accordance with the RBI scheme, they thought of converting it into a Indian subsidiary. RBI will welcome it. Till yesterday, you were a branch of a foreign bank, and now you are planning to convert yourself into a Indian subsidiary of that foreign bank. So, as a part of this conversion, there will be asset transfer, and there will be other things. Say for example, till yesterday, say that branch had some losses. after conversion, can the branch losses can be taken over by the subsidiary company? Those confusions are there. So this is basically a note where it ends all the confusion. Like when the branch transfers its capital asset to the subsidiary, it is not regarded as transfer. Number two, that branch, that subsidiary company can claim depreciation on the balance value, that is the WDV value of the assets held by the branch. So this circular addresses certain issues in relation to that conversion. Are you with me? It does not have any much purpose to serve when it comes to our examination. So basically applicable to a foreign company engaged in banking business in India through its branch situated in India, which is converted into subsidiary company in accordance with the RBI scheme. First of all, capital gain on conversion shall be exempted subjected to condition. Whatever capital gain, because till yesterday it was a foreign company's branch. Tomorrow onwards you are planning to convert yourself into a Indian subsidiary company. So both of them are different persons according to the income tax law. So there can be a transfer of capital asset from branch to the subsidiary company. These things are not regarded as transfer, subject to the satisfaction of these conditions. Number two, how do you compute depreciation? Because how do you get the opening values? Because from tomorrow onwards, you are actually a subsidiary company. To compute depreciation, you should require what? Opening balances. From where did you get the opening balances? You take the closing balances of that branch. That closing balance will be your opening balance because it is basically a reorganization, not a sale. Then, how about set off and carry forward? Can the subsidiary company set off and carry forward losses of the branch? Yes, because you are only one. It is only a technical process or a business reorganization that we have done. Then, cost of acquisition of non-depreciable asset. Say that after conversion, that particular subsidiary company is selling some of the assets of the branch. What should be the cost of acquisition? Previous owner's cost of acquisition. That branch's cost of acquisition shall be deemed to be the cost of acquisition of subsidiary company. Will you get the MAT credit? The answer is yes. You can claim all the MAT credit. What is MAT credit? That we will learn in assessment of company chapter. How about VRS compensation? Say that branch have paid a VRS to one of its retiring employee. 2 installments already done. VRS is claimed as a deduction in 5 equal annual installments. 2 installments branch already claimed. Remaining 3 subsidiary company can claim. Now, non-applicability of 56 subsection 2 clause number 10. Branch transfers something to the subsidiary company. In the hands of subsidiary company, it is not treated as gift because there won't be any consideration. Are you with me? There won't be, even if there is no consideration, it will not be taxable as a gift under IFRS. 56 subsection 2 clause number 10 is the taxation of gifts under IFRS. Then provision for bad and doubtful debts. That means the credit balance in the provision for bad and doubtful debts account made under 36 of the Indian branch shall be deemed to be the credit balance of the subsidiary company. Hope you remember, foreign branch can put a provision up to 5% of adjusted total income. That provision till yesterday was given by a foreign branch. From tomorrow onwards, that provision shall be deemed to be provision given by the subsidiary company because it is one and only the same. That's it. There is nothing more in that table. Moving on with the next one, there are certain miscellaneous provisions. How do you recover taxes from non-resident? Non-resident have to submit certain statements. Then furnishing of information by an Indian concern. These are purely administrative things. Again, I'm saying that these are never tested in exam. Not that important as well. If you have time, you can have a plain reading over the topics. Apart from that, there cannot be a numerical question based on this because it is basic other miscellaneous theory. So that's it.